Good evening, everyone. The last day live. Uh, this has had on a and we started with the topic of investment, and we have covered various. Uh, yeah, I said we will be along with uh, there is one property budget covered by that first, and then go for that. Let's just get started. Have uh, revised investment decision. We have seen that there are certain issues with it. First up, be very careful when making the investment because it has got certain characteristics. There is a certain amount of investment that goes into it. There's a long time period for which amount is being invested, and similarly, there will be the decisions will be irreversible, and the decision making is also going to be complex, right? Um, then we have seen what are the steps in capital budget and some of the principles that we are looking at in capital budget. First, we said that we should consider cash flows and not accounting profit. Second, it was we should look at after-tax cash flows. Third was to have a principal understanding of cash inflow is nothing but savings in out. Cash outflow is nothing but cash flow which is not received. Then we are also going to say considering the incremental cash flow and not the cash flow there and the side effects of the project also consider the effects of the project. Then we also stated that there will be impact of the working capital as a cash outflow with the year of introduction and that will take the cash outflow when we have the termination. Okay. Right? So, yeah, or one thing. Okay, yes. Okay.
Yeah, I think now it should be good. Can you please confirm, guys? Can you hear me clearly now? Should be able to hear me now because I've changed the system.
We can hear you, and
Yeah.
kindly proceed.
Okay.
Dr. Sen Gupta this side.
Yeah, sir. Okay, fine. So you're revising that. What are the principles of the capital budgeting, and that we reached till impact of the working capital. Later on, we started with the techniques in capital budgeting, in which we stated there are two categories of capital budgeting techniques. One is a traditional or which are non-discounting methods, and the second set of methods were time adjusted or the discounted cash flows. We've already discussed these two aspects, which is payback period and the average rate of return or accounting rate of return. And we have also started with these NPV IRR techniques. Payback period is something that we have already learned, which is the time period for which your money is blocked, or you can say the time period in which the initial investment will be recovered from the project. Then after that, we have went with the ARR, which was average rate of return or accounting rate of return, wherein we stated it should be profit after tax, which is the average annual net income divided by investment, and it's always going to be presented as a percentage. And the decision was to select the project with higher IRR. Then we started with the net present value, which was simply calculation of your present value of cash inflows minus present value of cash outflows. The decision rule that we have learned is if your NPV is greater than or equal to 0, we are going to accept it. If it is less than 0, then we are going to reject it. We have seen how to calculate these present value factors in the last class, wherein we just have to divide the rate added with it 1. So if it was 10%, we just have to divide 1 by 1.1. For multiple years, we just have to do equal to in the calculators. Then we said that since the NPV was greater, we concluded that we should be accepting the project. So another conclusion which we had from this decision was we are accepting the project because the return of the project is higher than the required return. So now, of course, since the return of the project, the return which the project is providing me is more than what is my requirement. So I was interested in knowing what will be that required rate of return. So we assume since at 8% we were getting positive NPV, obviously the project would be giving me a higher return. So we stated that project return should be higher. So we just discounted it with 15% and found that it was still positive. And then we went ahead and discounted the cash flows at 20%. And at 20%, we found that our NPV is negative. So from that, what we concluded is my project return is somewhere between 15% and 20%. And that made us do this interpolation activity. So we just did the interpolation between 15% and 20% to make our NPV as 0. So that was a method that we used to calculate the IRR. Right? Post IRR, we have also discussed the profitability index, which was present value of inflows upon present value of outflows. It simply stated that for every 1 rupee of investment, what is the amount of cash inflow in the present value terms. Post that, we also learned the discounted payback method. In the discounted payback method, it is similar to the payback method, but payback period, but we're not going to consider the actual cash flows, but we will be discounting the cash flows and considering them to calculate the payback. Okay, so that's what we have completed till the last class as far as the capital budgeting is concerned. So out of these methods that we have discussed, yeah. So we're done with NPV, we are done with profitability index, we're done with IRR, we're done with discounted payback. Now one method is left out, which is a modified internal rate of return. Let's quickly do that and then we'll proceed for the practical problem discussion. Okay, so modified internal rate of return, or what we call as MIRR. Now, in this method of capital budgeting, which is modified internal rate of return, it is again, as the name says, internal rate of return, which means the rate of return which we are going to arrive at from the project. But one assumption which we had in the calculation of IRR, that is going to be rolled back. It means whatever cash flows we were receiving in the IRR method or in our NPV calculation also, we were withdrawing that money from the project. But now in MIRR, what are we essentially going to do is whatever cash flow we are receiving, we are going to reinvest it. So let's say, for example, we have a project with the cash flows which you have already discussed, which is the same question which you have taken for our understanding. Yeah. So the cash flows that we are receiving, we're stating that we're not going to withdraw it from the project. Rather, we are going to reinvest it at some different rate of return, or maybe at least our cost of capital. Okay, so reinvestment rate is something that we're looking at. First, we'll understand how do we calculate this MIRR, and then we'll see what is the reason to calculate MIRR and how is it a better form of IRR. So let's say you are investing 10 lakh into a project, and that project is going to provide you this series of cash flows. So you have 3 lakh, 5 lakh, 6 lakh, 5 lakh, and 4 lakh coming in from the project from the subsequent years. I can definitely calculate the IRR for this project, which we have already done in our example. Right, so we have already calculated the IRR for this project, right? So, but as I say, IRR was having some sort of an assumption that may not be valid. What is that assumption? Just hold on. I will prove to you what is that assumption. But if I want to calculate MIRR over here, we are saying that these cash flows will be reinvested. This will be reinvested at least at our cost of capital. So if I ask you, reinvestment time period for each of these cash flows. So let's say the cash flow that you're receiving in the first year, the cash flow which you're going to receive in the first year, can you tell me for how many years this can be reinvested if I want to keep it invested till the project gets completed? So the cash flow that you're receiving in the first year, you're going to reinvest it for how many years? If you're supposed to withdraw the money at the end of the project. Of course, this is going to be invested for 4 years, right? Because since you're receiving it in the first year, you'll keep it reinvested for another 4 years so that you withdraw the maturity amount in the 5th year. In the second year, the cash flow that you're receiving, that will be reinvested for 3 years, right? Then the third one will be reinvested for 2 years. Fourth one will be reinvested for just 1 year. And the fifth cash flow won't be reinvested because that's the end of the project, right? So now, since we have got this reinvestment schedule, reinvestment time period, we would like to know what is going to be our maturity. We would like to know what is going to be our maturity of these cash flows. So maturity, let's say our cost of capital is, it was 8% that we have taken, right? Cost of capital is 8%. So maturity value is simply calculation of the compounded value, which we do it as 3 lakh multiplied with 1.08. So 3 lakh we multiplied with 1.08, that gives us so 3 lakh into 1.08, which is 3,24,000. So this is the maturity value that you are going to receive, right? So this 3,24,000 is what you're going to receive at the end of the 5th year. Same way, if you check for the other values, it will be 5 lakh multiplied by 1.08 square, then 6 lakh multiplied by 1.08 cube, 5 lakh multiplied by 1 point. Sorry, this is my bad. So this 3 lakh is going to be invested for 4 years. So into that's going to be 1.08 to the power of 4. Then second year that you are reinvesting, you're reinvesting it for 3 years. So your amount is going to get compounded for another 3 years. Then the third year investment is going to get reinvested for 2 years, and this is for 1 year. And finally, the 4 lakh amount which you are receiving in the fifth year, that will remain as it is. Now, let me just get the values of the maturity over here. 1.08, that raised to 2, 3, 4 into 3 lakh, which makes it as 4 lakh 8,147. Then for the second year cash flow which you have reinvested, that will be 1.08 into square and then cube. So this into 5 lakh, which will make it 6 lakh 29,856, and then 1.08 into equal to, and then into 6 lakh. That will be 6 lakh 99,840, and the final figure investment of 5 lakh into 1.08, that becomes 5 lakh 40,000. So if you just take a total of all of them, the final maturity value, we can obtain it 429,856 plus 699,840 plus 5 lakh 40,000 plus 4 lakh, which is 26 lakh 77,843. Okay, so this is the final maturity value of all your intermediate cash flows. So in essence, when you're going to reinvest these cash flows and you're going to get the maturity value at the end of the project, so this entire thing gets converted to a simple cash flow structure or a net cash flow structure as 0th year you are investing 10 lakh, and directly in the 5th year you are arriving at 26 lakh 77,843. So now this project which was having intermediate cash flows, we are assuming that the cash flows are simply getting reinvested and you are receiving the entire maturity value at the end of the term. So in this scenario, if you look at, you have invested in year 0 and you are getting your money directly in 5th year, or you can say 10 lakh which you have invested in year 0, that's becoming a final maturity value of 26 lakh 77,843. So now if I ask you, what is the rate of return that you have earned from this project by reinvesting your cash flows? By reinvesting your cash flows at a maturity, at a rate of 8%, we can get it simply by forming a mathematical equation as amount is equal to principal into 1 plus I raised to n. Amount in the form, we have the final maturity value, which is 26 lakh 77,843. That's equal to 10 lakh into 1 point, we don't know what's the rate, so 1 plus I raised to 5. Okay, so now you can just do the mathematical calculations. 10 lakh divided 26 lakh 77 getting divided by 10 lakh, that will make it as 2.6778 as 1 plus I raised to 5. Okay, so 2.6778 equal to 1 plus I raised to 5. You will be provided a compounding factor, of course. So we are essentially interested in knowing what is this compounding factor or what is this I. So we can get it as simply 2.6778 to the power of 1 by 5 as equal to 1 plus I. So now how do we get this 2.6778 raised to 1 by 5? Are we aware, guys, how to compute this fifth root of a number? You can do it in your scientific calculators, but as we know, scientific calculators we're not going to use. But you need not worry over here, because a compounding factor for this sort of things will be provided in the exams, or you can also calculate it by way of calculated trick also. I'm not sure about how many of you are really aware of it, but you can do it simply by performing certain steps. Let me see if that trick really works on my computer calculator. So what we do is 2.6778. We're going to do 12 times root. Just 2.6778. First, let me get the answer. We want the fifth root of 2.6778. This is coming out to be, 1 second. 2.6778. Yeah, 1.2177. This is 1.2177 equal to 1 plus I. Okay, so I is basically 21.77%. Okay, so you will be provided in the exams that there is a compounding factor at 21.77, which is 2.6778. Okay, now this is what the MIRR of the project is. This is the modified internal rate of return of the project. Let me just wait 1 second. See the calculations. 1.2177. Yeah, perfect. Okay, how can we solve this in type of examination hall? So I'll just list down certain steps. You students can just perform these steps and see if you are able to get it. If you have a normal calculator, the steps which you can perform to get this fifth root, rather, to get any root of a number in your calculator, you can get this. First, what you do is you type the number, or type the number A. Second step is press root button 12 times. Okay. Then third step, what you do is subtract 1. Next, you divide this with n, whatever is the n over here. Like over here, we had the fifth root. So you just divide it by 5. And then in the fifth step, you add 1. And in the sixth step, you have to press both multiplication and equal to 12 times. So there is a mathematical reasoning that goes behind it, which is a limits problem. I'm not going into that details, but these are the steps that you can perform. So I'll just show you if that really works over here in my PC. Let's say we have 1.2177. So we have to press the root button 12 times. So let me just take the square root 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, so 12 times root. The next step is subtract 1. Okay, so on subtracting it with 1, this is what we get. We just need to divide this by n, which is 5 over here. So I just divide it by 5. And then we have to add 1, which is plus 1. And after that, we have to do into equal to, multiplication and equal to 12 times. So multiplication equal to, then we have multiplication equal to 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, this thing doesn't work on my iPad over here, but this is definitely going to work in your normal regular calculator skills. You can just check it out. If you're not able to get this, you can ask me in the query session at the end of our today's class. Okay, so anyways, getting away with this calculation part, what we have learned is the project is giving me 21.77% return, which is the MIRR, but this is subject to an assumption. Okay, it works. Shruti is saying that it works, sir. Okay, fine. Great, Shruti, if you have got it. So 21.77 is the return that we are receiving from the project under an assumption that we are able to reinvest our cash flows at the cost of capital. Now, why was there need for this MIRR part? Because when you're just calculating IRR, there is an underlying assumption in IRR that whatever cash flows the project is providing you, you are able to reinvest it at the same IRR. That is what the underlying assumption of the IRR method was. I'll just show you with example how is this assumption truly valid. Like in our case, in the last class, we have computed the IRR for this project, right? We have computed the IRR of this project to be, in the previous class, 15.8926. Okay. So let me just take those numbers again. Okay. So this project, we have stated that it has got a IRR of 15.8926%. Okay, so this is what we have already calculated. Now, as I said, if you are looking at IRR as a measure of rate of return from the project, there is an underlying assumption which says that all these cash flows are also reinvested at this rate if you want to determine the final maturity value. The final maturity value which you're going to get is said to be arrived at by reinvesting the cash flows at this 15.8926% itself. If it is something other than this, then the project is not going to give you a return of 15.8926. Okay, so let me just quickly prove it to you with the help of Excel calculation. See, I'm just doing this for ease of you don't waste time in calculating much things. Yeah, so we have the cash flows over here. We have here 0, 1, 2, 3. So 3 cash flows in which we have got cash flow of investment of 7,50,000 in the first year. Then in this first year, you realize a cash inflow of 3 lakh, 4 lakh, and 3 lakh. Now, if I ask you what is the reinvestment time periods or reinvested for, obviously the first year is first cash flow that you're receiving. That's getting reinvested for 2 years. The second year cash flow is getting reinvested for 1 year. And of course, there's no reinvestment period for the third year. As I stated that when we did the IRR calculation over here, our IRR in this case was 15.84 or what was that? 15.89 is what we have got. But again, that was an approximate number. 15.84 is the IRR. When we look at this number, we have an underlying assumption that all these cash flows are also reinvested for the time period for at this 15.84%. So if I'm going to consider this as my reinvestment rate, then only my final maturity value will be giving me the IRR return when I compare it with the initial investment. So let's say this is reinvested for 2, 1 or 0 years, and we look at the calculation of the maturity. Now, the maturity value, of course, we're not interested in the 0th year maturity. But the first year cash flow is multiplied by 1 plus, if I take this 15.84% as the reinvestment rate, this will be to the power of reinvestment period. Okay, so final maturity value that we get is this 11,65,980. This is the final maturity value. So over here, this entire project I can sum it up as year and the cash flows. So in the 0th year, we made an investment of 7,50,000, and finally in the 3rd year, we are going to receive the cash flow of 11,65,980. Okay, so now if I want to know what is the rate of return, I can simply calculate it as 11,65,980 equal to 7,50,000 multiplied by 1 plus some rate to the power of 3. And we really want to know what is that rate, or IRR. So we divide this with 7,50,000. This divided by 7,50,000. That will be 1 plus I to the power of 3. So of course we want the cube root of 1.55464. So I just take it as to the power of 1 by 3. So cube root is this, and then we say that our IRR, I basically this is 1 plus I. So finally we get the IRR value as this 1.5884 minus 1. That's 15.84%. So IRR value is 15.84%. Can I say it's just the same that we have got over here, right? But if you are not able to reinvest at this same rate, or you can say this is maturity at the rate of 15.84%. But it is not mandatory that whatever intermediate cash flows that you have, you will be able to reinvest it at the same rate. That's not possible, right? So taking a more realistic scenario, we say that suppose we are able to reinvest it not at 15.84, but let's say we'll be able to reinvest it at just maybe 10%. So in that case, our maturity value, the realistic maturity value which we can realize from the project is also 10%. And therefore, these numbers are definitely going to change. So my maturity value, taking 10%, will become this. And my final maturity value is also going to change to 1 crore 10 lakh 3,000. 11 lakh and 3,000 is the final maturity value. So if I want to get the rate of return over here, I'll again write down the year and the cash flows. So your investment is 7,50,000 in year 0. And finally, in the 3rd year, you have this maturity coming in. So now your rate of return will be 11,03,000. That's equal to 7,50,000 into 1 plus I to the power of 3. Now, if you solve this for the value of I, you can simply get this as this divided by 7,50,000. Yeah, so you have this as 1 plus I to the power of 3. Right, so now you can say that your I value simply this to the power of 1 by 3 and then you subtract it with 1. So you get the realized rate of return is 13.72%. So if you're able to reinvest the cash flows at a rate of 10%, if you're able to reinvest the cash flows at the rate of 10%, the project is going to provide you 13.72%. So that's how we compute the modified internal rate of return. Is it clear, everyone, how to compute the modified rate of return and what is the reasoning behind that? Yes, are we clear? So shall we go ahead with the module question discussion now? I'll just paste it on the file that we are doing it so that I can upload this on the portal. Are we clear? Okay. Then let's discuss the module questions now, right away. So here I have a module in front of me. Just give me a moment. Okay, so from the module, some specific questions I'm going to discuss, and if you have any questions to ask for, you can definitely ask it in the last half an hour session of our query. These are the basic questions initially we have, which I've already covered. Okay, let's look at illustration number 13, guys. Let's look at this illustration number 13. Wait, before 13, we would like to also look at few questions before that. Yeah, illustration 10. Let's look at illustration 10. And we'll also identify some nitty-gritties that we are yet to discuss about the capital budgeting decisions. Suppose, look at this illustration 10. Suppose there are two projects A and B which are under consideration. Cash flows associated for these projects are as follows. So you have two projects A and B with obviously two different amount of investment getting involved. So first project has an investment of 1 lakh. Second project requires an investment of 3 lakh, which is occurring over year 1, 2, and 3, which is 50, 60, 40, and 140, 190, and 1 lakh. We have to assume the cost of capital as 10%. Identify which project should be accepted as per NPV and IRR. Now we are pretty sure how to calculate the NPV and IRR. My point is not to calculate NPV and IRR, but to highlight you some important aspect when we are comparing both types of evaluation rule. So the question is already solved. We have the NPV figures and they have also given us the IRR figures. So our position is looking, we are looking at this final result and how we are going to discuss, how we are going to solve this. See, project A is giving me an NPV of 25,050. Project B is giving me 59,300 as NPV, whereas IRR, project A is 24.26% and project B is 21.48%. So there's a contradiction in ranking by both methods, right? Because as per NPV, you should be going ahead with this project. And as per IRR, you should be going ahead with this project. So according to NPV, project B should be chosen. According to IRR, project A should be chosen. Now the point is, which cash flow or which project should we really choose? Because both the methods are giving me different answers, right? So this is one typical scenario where you can get contradictory results for NPV and IRR. So first scenario is when the initial investment is different. Of course, you may get contradictory results. When can you really get the contradictory results in other case? See, so first case we are saying IRR and NPV can give you contradictory results only if the one case is if the scale and size disparity is there. Like in our case, project A was having an investment of 1 lakh, B was having an investment of 3 lakh. They were giving me different answers, or different methods were giving me different conclusions. So in case of being an IRR and relative measure and NPV an absolute measure, in case of disparity in scale, or both may give contradicting ranking. So when you have these contradictory results, one such scenario is different amount of investment. Second is when there is a time disparity in cash flows. So time disparity of cash flows means, like, look over here. Project X, of course, there is a disparity in the initial investment, but more important to identify is the cash flows that are happening in year 1, 2, and 3. See, project X is giving me higher cash flow in initial years and lower cash flows in subsequent years. Project Y is giving me lower cash flows in first year and higher cash flows in the subsequent years. And then we are going to calculate the NPV and IRR. Let's have a look what is the final result. See, as per NPV, project B should be chosen, and as per IRR, project A should be chosen. Again, there is a contradiction in ranking by both the methods. There's a contradiction in ranking by both the methods. Okay, so it might be possible that overall cash flows may be more or less the same in the project, but there may be disparity in the flows. That is the pattern in which it is coming, and that's what we observe, that it's going to provide us opposite results. Now, there may be a case that again a contradictory results may come when we have disparity in the life of the proposals or unequal lives of the project. So, like over here, project A has got an investment of 5 lakh and 7,50,000 in the first year. That's it. There is no cash flows in second and third year. But project B is having cash flows in the subsequent years. And if I calculate the NPV and IRR for these projects again, you can see project A is having a NPV of 169,750 and B is having a NPV of 336. So of course, in that situation, project B will be chosen as per NPV criteria, but project A will be chosen as per IRR criteria. Okay, so these are the three areas where you can get contradictory results. Now, what do you feel? Which method should we really follow? Should we listen to the conclusion of NPV, or should we listen to the conclusion of IRR when there is a contradictory results coming from both the methods? What is your take on it? Should we be listening to NPV or should we be listening to IRR? Because both of them are giving me contradictory results. So whenever we have such contradictory results, IRR is telling me to accept project A, NPV is telling me to accept project B. So which one should I really select? Should I be going with the sayings of NPV or IRR? What do you feel, guys? I expect an answer from you. What do you feel? What should be our decision? Should we listen to NPV or should we listen to IRR? Yep. Whom should we listen to? Should we accept the judgment given by NPV or should we accept the judgment given by IRR? Yes, tell me, Shruti. Aditya, Sushil. Okay, so Shruti is thinking it should be NPV. Okay. Okay, few of them are saying NPV, few of them are saying IRR. Let me clear the air over here. You're always going to follow NPV and not IRR. Let me tell you why. With a very simple example. I'll just take a very simple example to help you explain why should we listen to NPV and not IRR. So there is a project A and there's a project B. And let me write down the year. So you have first year and 0th year and first year, just 1 year project. So in project A, you're going to invest 1,000. After 1 year, you're going to get 1,300 from the project. Project B, you're going to invest 10,000. And after 1 year, you will be getting, let's say, 12,000 from the project. Okay. So now, if I ask you what is the IRR, what is the rate of return that the project has given? Can you tell me what is the rate of return given by the project A and B? What is the rate of return given by project A? And what's the rate of return given by project B? Can I say rate of return given by project A is 30%, right? And project B has given you 20% rate of return. Because the 1,000 is becoming 1,300. So 300 is something that you're getting extra. And in that case, in over here, you're getting 2,000 extra, which is just 20%. Okay. So IRR is 30% and 30% of project A and 20% of project B. But if I want to calculate the NPV over here, NPV, let's say our cost of capital is 10%. So NPV will be 1,300 divided by 1.1 minus 1,000. So this will be 1,300 divided by 1.1 minus 1,000. So your NPV is 181. Whereas in second project, your NPV will be 12,000 divided by 1.2. Sorry, 12,000 divided by 1.1 minus 10,000. 12,000 divided by 1.1 minus 10,000. So here you have the NPV as 909.9. Now, if you don't have any constraint with regards to investment amount, it means you can invest 1,000 or you can even invest 10,000. But the point is you can choose either A or B. If you are investing in A, you will definitely invest 1,000. You will be able to get 1,300. But the net benefit that you have in absolute terms, net value which you have in absolute terms coming into your profits or coming or adding to your value is 181. So that's 181. Whereas if you look at project B, the net benefit that you have is 909. If you're going to accept project A, 1,000 is invested, but your 9,000 is remaining idle. Your 9,000 is remaining idle and that is not put to use. So it doesn't make sense for me to keep that 9,000 idle and just earn 30%, which in turn translates to just 181 rupees. Which in turn, just translates to 181. Whereas project B, you invest your 10,000 fully, and you're going to get an NPV of 909, which is of course a better value addition than 181. If you accept this project, your wealth, your present value will increase by 181. But in project B, your present value will increase by 909. And you might have already learned that the final aim of of a finance manager is to enhance the value of the company and the value of the shareholders. So by just keeping that 9,000 idle with you, you're not going to add any value to the company. So if you want to add value to the company, you will have to choose the project which has got the highest NPV. Okay, is it clear why you should be going for NPV? Are we clear, guys? Right? We should look for projects which has got the highest NPV, because that indicates the value addition which we are able to generate. Are we good? Shall we proceed? Aditya is asking, what if 9,000 added in project A? 9,000 you cannot invest in project A. Project A is a small project, wherein it requires investment only 1,000. Even if you invest 9,000, you will not get anything back. You will still be receiving 1,300 only. So it's a smaller project. So this project is giving you a higher IRR, because of the smaller amount of investment. Okay, had it been a case, this is also 10,000, this is also 13,000. Of course, our NPV will be also 1,810. Then that will be also a higher figure. But here the disparity comes because the size is different of both the projects. Okay, fine. Then we're looking at some special cases in the capital budgeting decision. Okay. Anything we have to compare on? Only Krishnan is asking, anything we have to compare on equal footings? Of course, equal footings. But then if the projects are not on equal footings, then you will have to choose a project which has got the highest value addition for you. Right? Okay. So the next special case that we're looking is capital budgeting under capital rationing. Now, what's capital rationing? Capital rationing is basically, it's a scenario where you don't have unlimited access to capital. So there is a limitation, or there is a budget which is set for you, as to what will be the maximum investment which you can make. Okay. So this is what we are looking at, typical capital rationing, wherein you have limited funds available with you. So it can be a case that projects are independent of each other and are divisible in nature. Now, what do you mean that projects are divisible in nature? It means you can have another, player, or you can have another participant participating in your business. So in such situation, NPV rule should be modified, and accordingly, projects should be ranked on the basis of NPV per rupee of the capital. And in such situation, projects should be ranked on the basis of absolute NPV, and which should be mixed up to a point available resources are exhausted. So we are looking at these two cases where the project is divisible in nature. So project is divisible in nature means I can participate that project in bits also. Like I can have just 25% stake in the project, or I can have just 30% stake in the project. Then you say that the project is divisible. Whereas if the project is not divisible, it means it's a give or take. Either you take the project or you just leave the project. You cannot take in part, or again, you don't have any co-venturer coming along with you. So let's take an example, the illustration 13 which we have on our module. So Shiva Limited is planning its capital investment program for next year. So for the next year, we have this capital investment project where they have given 5 projects available to us. We have got a cutoff rate as 15%, and these projects have been already calculated using NPV. So the company is limited to capital spending of 1,20,000. So it means the company cannot invest more than 1,20,000 in the company. You are required to illustrate the return from a package of projects within the capital spending limit. The projects are independent of each other and also divisible. That is, part project is also possible. Right? So we can also have a part project over here. So company is going to be, having a limited spending capacity of 1,20,000. So first case is we say for each of these projects, let us compute NPV per rupee of investment. NPV per rupee of investment. So I can get over here NPV per rupee of investment. How do I get this NPV per rupee of investment? You just need to divide your NPV with the investment value. So this is like 15,500 divided by 50,000. One second. So let's say per rupee of investment, what is the NPV? So 15,400 divided by 50,000, that's 0.308. So every rupee that you invest, that's going to give you 30.8% in return as far as first project is concerned. Second project, you have 18,700 divided by 40,000, which is 0.4675. Third is 10,100 divided by 25,000, which is 0.404. 11,200 divided by 30,000, 0.3733. And 19,300 divided by 35,000, which is 0.5514. So these are the NPV values that we have. So NPV per rupee of investment, right? So which of these projects is going to provide maximum return or maximum NPV for every rupee of investment? For that, we are just going to rank them. So we can rank them. We can simply rank the projects and then decide which project is to be accepted. So first rank is obviously going to this one. Second to project B. Third is going to project C. Fourth going to project D. And fifth going to project A. So these are the ranks that we have. Now, based on this rank, we are saying since the project are independent, that is part project is possible. In that case, we are going to invest first. Our investment of 1,20,000, will be spent on the rank 1 project, which is 35,000. So after investment of 35,000, you are left with 85,000, right? So this is gone into project E. From that 85,000, you will go to the second ranking project, which is project B, and that is 40,000. So you spend that into 40,000 in project B. So out of 85,000, 40,000 is spent in project B. So how much is left over with us? We still have 45,000 available with us. So now we go for project ranking 3, third rank project, which is project C. So C requires an investment of 25,000, right? And we are still left with 20,000. Now this 20,000 we would invest in the project D, but we won't be able to invest the full value in project D because the project D requires 30,000 investment. So in D, we would be having 2/3 investment, not full stake in that investment, but we'll have 2/3 investment. And that's what is stated in the solution also. You can say 35, 40, 25 and 20 investment in D. And then you just write down the NPV, take the net total NPV of all the projects. Okay. Now, if the projects are not divisible, if I say projects are not divisible, it means you will have to choose the project in entirety. You cannot have a part ownership of the project. Then you'll have to look for combinations which needs to be examined. So combinations can be whichever combination fits within our budget of 1,20,000. So within our 1,20,000 budget, Of course, we will be first choosing the project with, first ranking. And we can also say first, the second ranking is also possible, 35 plus 45. Third ranking, you can go to 25,000. So 35 plus 25 plus 40, that translates to 1 lakh. We are still left with 20,000. Right. So over here, investment will be 100. Or the second option is again look for EB, and along instead of C, you can go for D. Now, out of these two options, which one is a better one? Of course, it is this 49.2, which is the better option because that provides you the highest NPV. So in case of projects are not divisible, you start with choosing the project with highest rank. And when you're reaching at the fag end of the ranking, then start looking for the alternatives for the last option. And then see what is the NPV number over here that will give you the highest NPV under the combination. So that is one way. Other is sometimes you may have to choose a project which have got unequal lives, wherein they have got the different lives altogether. Like for example, over here there is a project A, wherein you are going to invest 40 lakh. That's going to provide these cash flows. Project B, wherein you're going to invest 20 lakh, which is going to provide you these cash flows. And the NPV at 12% is already calculated. IRR is also given. Now, which project am I really going to choose? So here the disparity is due to the change. There's a disparity in the timeline. So whenever there is a disparity in the timeline, we are going to choose the project based on a criteria called as equivalent annual criteria, or based on common life method. Now, what would be the common life method? Common life method would be, in project A, 40 lakh is invested for a period of 6 years. If I want to have a comparison, I need to do one thing, that project A is going to have a cash flow of 40 lakh today, and then inflows in the next 6 years. But B is having a different set of cash flows. So what we assume is, let's say B runs for 3 years. For the balance 3 years, again the project B will be undertaken, or I can say, we will say 20 lakh will be reinvested in the third year. That will be providing you 7 lakh, 13 lakh, and 12 lakh cash flows again. And then you compute the NPV. So since the life of project A is 6 years and project B is 3 years, to equalize the lives, we can have the second opportunity of investing in project B after one-time investment. So after invested once, the project gets over in the third year. So now you say, to make it comparable, we will invest again in the third year and realize the money in the 6th year. The NPV of the extended life is 6 years of project B shall be, this, if you take this as 6 years, so that comes out to be 8 lakh 82, which is far better than the project A. So project A in its entirety, in its own, is able to have an NPV of 649. And if you're looking for repeating the project B after 3 years and taking this cash flows, you will have a NPV of 882,403 and IRR of 25.2%. So IRR is 25.2%, but here the NPV is again working in your favor, wherein we say NPV is higher, so we should go for this project. Or the second criteria to evaluate such project which have got different lives is to divide your NPV figures by present value annuity factor, because this NPV is generated over a period of 6 years, and those 6 years have got a present value annuity factor of 4.11, whereas project B is having a NPV of 515,488 over a period of 3 years, which has got a present value annuity factor of 2.402. So you just need to divide them and calculate the equivalent annualized NPV. So these numbers are annualized NPV. Okay, so these numbers are basically annualized NPV. And based on this criteria, of course, project B should be chosen. So when a projects have unequal lives, there are two ways. One is to make the life of both common. Second is to calculate the annualized NPV by simply dividing your NPV with present value annuity factor. Okay. Okay. So these are again some questions, not much. Again, practice questions, just cash flows are given to you, not a sort of thing. Numbers which we have already solved a lot of questions. Yeah, from question illustration 18 onwards is something, we are 18, 19, all these are innovative questions or sort of case study type of questions. So we'll take up these questions post a break right now. So let's take a break right now, guys. After that, we'll be looking at question 18, 19, and some other uh, practical problems on the module also. So let's take a small break of 10 minutes, guys. We'll resume post that. Okay. So welcome back, guys, after the break. We're discussing the questions from ICAI module. Now, let me just do this illustration 18 and 19, and then we'll go for some of the practical problems. So, solving them in Excel so that, calculation part, timing we are saving on. Yeah. Let's look at the question first. So we have HMR Limited is considering replacing a manually operated machine with a fully automatic new machine. So we're looking for replacing old machine with a new one. And this new machine is going to have some sort of other different characteristics as compared to the old one. The old machine has been fully depreciated for tax purpose. So in the income tax, we have fully claimed the depreciation of this old machine, and but has a book value of 2,40,000 on 31st March. The machine has been causing problems with breakdowns, and it cannot fetch more than 30,000 if it is sold in the market at present. It will have no realizable value after 10 years. Now, this old machine can be run for another 10 years. After 10 years, it's going to be having no realizable value. Machine has been causing problems with breakdowns, and it cannot fetch more than 30,000 if sold in the market at present. The company has been offered 1 lakh for the old machine as a trade-in on new machine. So if I'm going to get a new machine in exchange of the old machine, then I will be able to get a discount of maybe 1 lakh on the new machine. The new machine, which has a price before allowance for trading, as 4,50,000. The expected life of new machine is 10 years with salvage value of 35,000. So new machine is going to have a salvage value of 35,000. Further, the company follows straight line depreciation. So company is following a straight line method of depreciation for taxation purpose. Written down value method depreciation at 7.5% is considered. That is only the machine in the block of the asset. So the new machine is going to be only there in the block of asset. No other machine is there. So given below are the expected sales and cost from both old and new machine. So from old machine, whatever are your sales up to the profit after tax, those are the numbers which are given. And same has been given for the new machine. So from the above information, we have to analyze whether the old machine should be replaced or not. If required rate of return is 10%, and we have to ignore the capital gain tax. PV factors has been already given to us. Okay. Now, our decision over here is whether to replace the machine. So now to replace the machine, I have to take it in an incremental manner. So incremental manner means we will be purchasing the new machine by trading in, by exchanging the old machine. And what is the incremental cash inflow or outflow that's going to happen? That is what we are supposed to be looking at when we want to decide whether this machine should be replaced or not. So first of all, I need to know what will be the base or the cost of the new machine, right? So cost of the new machine is something that we need to compute. So cost of new machine for depreciation, right? So it's like we have the purchase price, which is 4,50,000, and from that we will be reducing the sale price of old machine. So sale price of old machine is 1 lakh. So we can say the net cost will be 3,50,000. So we will be able to claim depreciation only on this 3,50,000 because we will be anyway selling out the old machine. So as we are going to sell out the old machine, 1 lakh will be something that we will be receiving. And since this has been fully depreciated in our books, the old machine has been fully depreciated. So you can just say 4 lakh for 50,000 is the cost of the new machine minus 1 lakh is the sale value that you're receiving. Okay, so we need to get the depreciation figure on this 3,50,000. Okay, but remember that depreciation for the purpose of tax is 7.5%. In our books for old and new machine, we already have the figures of profit before tax. So we will need the number of profit before depreciation and tax. Remember the principle that we had set while we were looking at how to calculate the cash flow after tax. So we said that our calculation begins from profit before depreciation and tax. So we need to compute the profit before depreciation and tax, right? So we'll say computation, or we can say calculation, profit before depreciation and tax of old and new machine, right? So let me just say old machine, new machine, and then we'll look at what is the incremental or the difference. So as per our books, profit before tax is 3,24,750, and new machine is going to provide us a profit before tax of 3,87,250. Okay. So old machine is having a PBT of 3,24,750. 3,24,750. New is having a PBT of 3,87,250. So of course, in difference point of view, we can say the new machine is going to provide me a before tax profit of 62,500. Now I need to get the profit before depreciation and tax because I'll be claiming depreciation as per income tax allowance. So from PBT, we need to add back the depre as per books because we will be claiming depreciation as per income tax. So let's just add back the depreciation as per books. So as per books, the depreciation is 24,000 and 41,500. So as per our books, we can say 24,000 is what we are charging in our books. But sir, you said that in income tax it has been fully depreciated. Yes, in income tax it has been fully depreciated. But for books, in our books we still have the balance left. So I just need to obtain the profit before depreciation and tax. So I can say my PBT is going to increase by 62,500 and also my depreciation is amounting to 17,500 incremental depreciation as per books. So of course incremental profit before depreciation and tax will be as per old machine it is 348,750, as per new machine is 428,750, and finally you can say the differential or incremental extra profit before depreciation and tax which will be generated by this new machine will be 80,000. Now we have to compute the cash flow after tax. So we'll say calculation of cash flow after tax. So this CFAT we can compute it for a total period of 10 years, right? So let me just get the total period of 10 years. So I'll write here year, which starts with 1, 2, 3, 4, 5, 6, 7, 9, 10. On this, we start with profit before. This as incremental profit before depreciation and tax. So every year, the profit before depreciation and tax, the incremental profit before depreciation and tax is remaining same, which is 80,000. Okay, so that 80,000 remains same. But from that, we are going to reduce the depreciation figure say less depreciation as per income tax. So depreciation as per income tax, it is 7.5%. So that's going to be 7.5% of our cost of machine, which you have computed 3,50,000. So we'll say 7.5% of 3,50,000, which is 26,250. Okay, for subsequent years, the depreciation is, since it is WDV based, you can say 26,250 multiplied by 1 minus 7.5%. Or they can say every year you're going to reduce the amount of depreciation by 7.5%, since it is to be done on a WDV basis. So as it is on a WDV basis, you can just drag it to get the depreciation figure as per income tax. As per income tax, your profit before depreciation and tax is remaining same, but depreciation as per income tax will be getting reduced every year by 7.5%. Once you have got the profit before depreciation and tax, now it's time for us to get the profit before tax. Profit before tax is 80,000 minus the depreciation figure. From this, we're going to reduce the tax. Tax rate is given in the question as 30%. So let us say on PBT, you take 30%. So that's the 30% tax which you apply throughout. Okay. Now, after that, 30% tax has been deducted. Now we arrive at profit after tax. So profit after tax will be PBT minus the tax figure. Okay. Now to arrive at the cash flow after tax, I just need to add back the depreciation. This is what we have already learned as a method of arriving at cash flow after tax. So you add back depreciation. So depreciation that will be added is what you have subtracted just for the tax purpose. To add the depreciation, that will give you cash flow after tax. So cash flow after tax will be profit after tax plus depreciation. Okay. So you can just drag it. You can't drag it. I can only drag it because you have to solve it in paper. So, but I'm just fastening up the calculation part. So CFAT is calculated over here. Now you can get the present value of each one of them by simply writing down the present value factor, which is given in the question. Present value factor, our cost of capital is 10%. So present value factor at 10% is something that we have. So present value factor numbers is given. So that's for the first year it's 0.909, then it's 0.826, then it is 0.751, and then 0.683, 0.621. One thing that I want you to remember is always take the PV factor which has given in the question. If the question has clearly stated what are the PV factors, don't do the calculation, because then the final answer may not match. Because some of you may take 2 digits, some others may take 4 decimal. So to avoid the discrepancy, Institute generally gives you the PV factors, and I would want you to also use the same PV factors as it is given in the question. 0.564, 0.513, then we have 0.467, 0.424, and 0.386. And then we take the present value of the cash flow. So present value will be CFAT, which is the cash flow after tax, multiply it by the PV factors. just simply multiplied by the PV factors, and we get the present value of all our cash flow after tax. So we'll say total of present value of cash inflow is simply taking the sum of all these numbers, right? So 3,81,000 is the total of all the cash inflows. Of course, we are going to also sell the new machine at the end of its life. So from that, we are going to add present value of salvage of new machine. So new machine has got a salvage value, which is the sale value of 35,000. The new machine has got a sale value of 35,000, and we just multiplied by the PV factor of last year, which is 0.386. We have this as 35,000 into 0.386, right? So that's adding the PV factor. Now, from this, we are going to reduce less cost of new machine. So cost of new machine is what we have computed as 3,50,000, and after subtracting and adding these parameters, we get the NPV, net present value. Net present value is your PV of cash inflows, add the present value of salvage, and reduce the cost of new machine. That gives us a NPV of 44,612.44. And since our NPV is positive, of course, the old machine should be replaced. Okay. Are we good with this, everyone? Did we get this? Any queries in this question? It was a very straightforward question, but involved a lot of calculation. Good, fine. So let me just take another question for discussion. The 19th, but something from which is the illustration. Okay, let's look at this question number 10. Question number 10. Let's try to solve this question 10. Yeah. So a large profit-making company is considering the installation of a machine to process the waste produced by one of its existing manufacturing process to be converted into a marketable product. So a large profit-making company is considering installation of a machine to process the waste produced by one of its existing manufacturing process. So we have an existing manufacturing setup in which we are producing some sort of waste, and we are looking for how do we go about processing that. Now, what's the situation as of now? As of now, we say the waste is removed by a contractor for disposal on payment by the company of 150 lakhs per annum for the next 4 years. So as of now, we already have a contract with a manufacturer, with another party, to whom we are making a payment of 150 lakhs. So every year we'll be making a payment of 150 lakhs for the next 4 years. Now the contract can be terminated upon installation of the new machine. So new machine, I can install it, and this contract gets cancelled. And of course, to cancel the contract, I'll have to pay a compensation of 90 lakh before the processing starts. And one more thing which they have stated is that these payment of 90 lakhs is not tax deductible. So this is not something which is tax deductible. So of course, if that's not tax deductible, we cannot get the tax savings on that. This compensation is not allowed as a deduction for tax purpose. The machine required for carrying out the processing will cost 600 lakhs. So we are going to buy this machine for a cost of 600 lakhs, and at the end of 4th year, machine can be sold for 60 lakhs, and the cost of dismantling and removal will be 45 lakhs. Sales and direct costs of the product emerging from the waste processing. So the waste that we are going to process, what's the sales and other costs involved in that? That's given over here. And all other details have been given. What are these costs that we need to incur for this product? So initial stock of material required before commencement of processing operation is 60 lakh at the start of year 1. Can you tell me what is this 60 lakh over here? This is nothing but working capital that we are investing. There's the amount of working capital that we are investing at the start of year 1, basically year 0. So in year 0, there will be an outflow of 60 lakhs. The stock level of materials to be maintained at the end of year 1, 2, and 3 will be 165 lakhs. So initially we are maintaining a stock level of 60 lakhs. Beyond that, the stock level has to be increased to 165 lakhs from year 1, 2, and 3 onwards. Right. So at the end of year 2, I need to have a stock of 165 lakhs. So from 60, I will have to make it to 165. So I need to spend additional 105 lakh as the working capital. And of course, at the end of year 4, the entire stock will be taken back. The storage of material, the material which we are looking for processing, that is going to will utilize a space which could otherwise have been rented out for 30 lakh per annum. So you could have rented this. You could have rented this space to someone else for 30 lakhs, which you won't be able to do now. So can I say this is income which is going to stop? So I'm going to treat that as my expenditure. Labor costs include wages of 40 workers. Post transfer to this process will reduce the idle time payments of 45 lakhs in year 1 and 30 lakhs in year 2. So there are already idle laborers who are sitting, to whom we would have definitely paid anyways 45 lakhs in year 1 and 30 lakhs in year 2. So this is the same example that we have discussed while we were discussing the principles, that if there is some idle labor, we are not going to include that as a part of our calculation of cost for decision making. Okay, so idle payment of 45 lakhs in year 1 and 30 lakhs in year 2. Factory overheads include apportionment of general factory overheads, except to the extent of insurance charges of 90 lakhs per annum payable on this venture. So the company's tax rate is 30%. Consider the cost of capital at 14%, present value factors for which is given up to 4 years. So again, in factory overheads also, whatever numbers they have given, these are allocated, these are absorbed, these are charged, right? These are not something incremental factory overheads. But they're saying 90 lakhs of insurance that we are undertaking, that is incremental in this case. So I'm going to consider only that as a part of our calculation. Consider the cost of capital as 14%. They have been given the PV factors. Advise the management on the desirability of the project and desirability of this project and installing of machine for processing waste. And we are going to form, of course, all the calculations are going to forming a part of our answer. So first step, whenever we are calculating NPV, remember guys, don't get stuck up, don't get stuck up, or you can say just lost in the question. Always be clear with the steps that we are supposed to be doing. The steps that we need to do is, first we need to get what is our cash flow after tax. What is our cash flow after tax from the operations of that project? And then you go ahead with the calculation of NPV. So the first thing that we are going to do is cash flow after tax. Okay, so we are going to see what is the cash flow after tax. Right, so say calculation of CFAT. CFAT stands for cash flow after tax. So this is nothing but the operating profits that we are talking of. So we start with year. So year ranges from 1, 2, 3, 4, 4 years. Now in each of these 4 years, what all operating cash flows you are going to have, considering the profit that you will have to calculate. So first, we need to take the value of sales. Sales values are given in the question, which are 966, 966, 1254, and 1254. We take 966, 966, 1254, and 1254. Right, and from the sales, we are going to reduce all the costs and going to add all the savings that we have. Okay, so from this, we will be reducing the material consumption. Material consumption is given in the question, which is 90, 120, 255, and 255. So let me just take the same. 90, 120, 255, and again 255. From that, we are going to further reduce the wages. Wages are given as 225, but remember the idle payments that they have given. As per the question, in year 1, 45 lakhs is the idle payment, and 30 lakhs is the idle payment in year 2. So I need to remove this idle payment from my wages expenditure. Wages are 225. From this 225, I'm going to remove 45 in year 1. So this is going to be 225 minus 45 in year 1. And in second year, that's going to be 225 minus 30. Okay, so that's 225 minus 30. For all the subsequent years, your wages are just remaining the same. Okay. Next, wages have been subtracted. Next is the other expenses. So I think other expenses, there is no problem at all because all the items are separately given. There is no absorption or allocation that's happening in the other expenses. So we're going to straight away deduct the other expenses fully. So other expenses are 120, 135, and 162, and then 210. Factory overheads. So we'll say less factory overheads. Whatever has been given as the factory overheads, that is what we are going to consider. So factory overheads is 165, 180, 330, and 435. But in the factory overheads, I stated that these are the allocated figures except the insurance expense of 90. So let me just take only 90 as my factory overheads because all other numbers are just allocation. So factory overheads, again, we need to reduce the depreciation. So depreciation is what as per income tax rule that's already given to us. 150, 114, 84 and 63. So you are subtracting the expenses from all the sales value. That's what we have done. But apart from that, we are definitely going to arrive at profit before tax. This is our profit before tax number. We still have some other adjustments left over. Will we do that? So to arrive at profit before tax, we subtract the costs from the sale value which we have identified. Now the tax. So the tax rate is anyways at the rate of 30%. So 336 into, take it as 30%. Right. So PBT multiplied by 30%, that gives you the tax. And then you have finally the profit after tax figure. So profit after tax is PBT less this. This is what we have got as a profit after tax. But there is one opportunity that we are losing out over here. Had it been a case, renting out the aspect, so the question we state that there is this space, the storage of material will utilize space which would have otherwise been rented out for 30 lakhs per annum. So I have got that opportunity cost of 30 lakh. Right. So that's we have the opportunity cost of 30 lakhs, which we are clearly losing out. Right. So the profit that we are, the opportunity cost which we are losing out, that is something which we need to take into account. So to this part, I'll just simply add the opportunity cost of rent. So every year we have this opportunity cost of rent, not add basically, it should be a subtraction because we are not earning. We won't be able to earn this rental now. So if I ask you PAT after opportunity cost impact, so 235 minus 30, and all the subsequent years we have profit after tax after giving adjustment for the opportunity cost of the rent, because we won't be able to earn this 30 rental which we would have earned earlier, right? So this is what we have got, profit after tax after the opportunity cost. Now we arrive at the CFAT by simply adding back the depreciation. So we add back the depreciation figure and we arrive at the CFAT, which is the cash flow after tax or operations cash flow after tax. Okay. Fine. 1 second. Wages, I think, yeah, it's 255 and 300. It's a mistake. 255 and 300 wages. Okay. So we got the CFAT. Now it's time for us to calculate NPV. Calculation of the NPV. So in NPV, we write down the particulars, year of the cash flow, present value factor, and then we take the PV. So in particulars, first thing that we take is initial investment, So what's the investment that we are doing in this project? So first of the investment that goes is, that's going in the year 0 with a cash flow of minus 600. Cash flow of minus 600 plus you will also have working capital introduced. So how do you get this working capital introduced? Remember, this working capital introduced is stated in the question that stock level needs to be maintained. So in the initial year, we are going to infuse 60, and in the first year, we are again going to infuse 105, taking out a total stock of 165. So working capital introduced in year 0 is 60, and again working capital introduced in year 1 is 105. Okay, so working capital introduced is 60 and 105 in year 0 and 1. And this is entire amount 165 is going to be removed in year 4. So 600 is the amount of investment. Working capital introduced is 60 and 105 because we want a stock level of 165 from year 1 and onwards. One more thing that's happening in year 0 is the compensation. Compensation for contract, because we already had a contract with one of the vendors who was going to collect our the waste and then disposing it off. So that's not going to happen right now because we are going to acquire a machinery for processing the same. So in year 0, there will be a cash outflow of 90, which is the payment of payment to the contractor as a compensation. Now, apart from that, you can also say, sir, we are saving on the contract payment, because if you're canceling the contract and paying 90, that's fine. But every year, which I would have paid 150, that is something I'm saving on, right? Because I need not pay that 150 now every time. Correct? So we say contract payment saved. Contract payment saved, which is going to happen from year 1, 2, 3, 4. In all the 4 years, you would have actually paid 150, but that 150 is something which was supposed to be an expenditure, but now you're going to take up this project, and this project is not going to involve this outflow. So that is where your savings on it, right? But I can definitely make this contract payment saved as an after-tax figure by simply calculating it as 150 multiplied by 1 minus 0.3. (150) multiplied by 1 minus 0.3. So this is 150 multiplied by 0.7. So essentially, the net savings that we have is 105, because I would have got a tax saving on the contract payment, right? Whatever contract payment I would have been making, that I'll be saving, because and the tax which I would have saved on that expenditure, that I'll have to pay from my pocket. So there'll be no tax deduction available from this. So that's like the after tax effect. Then we write down the cash flow after tax figures, which we have computed. So cash flow after tax is 355.2, and then you have 302.4, 339.6, and 268. That's your cash flow after tax. Okay. And then in the 4th year, we have salvage of machine rather. In the 4th year, salvage is simply going to be, it is stated that the machine will have a salvage of what was the salvage? Yeah, 60 lakhs is the salvage, out of which 45 lakh will be spent for just removal of the same. So net effect is like, I'll be getting 60, out of that 45 will be already spent. So in essence, I will be getting only 15 as a cash inflow, right? 15 will be the final cash inflow which I have. So this is our salvage value. Now I just need to write down the present value factors, which is obviously given in the question. 0.877 for the first year. Write down over here 0.877. Then 0.769. Then we have 0.674 and 0.592. These are the PV factors. And in the first year also 0.877. In the 0th year, the PV factors are of course 1. And then we arrive at the present value of all the cash flows, which is cash flows multiplied by the PV factor. So we multiply all our cash flows with the PV factor. And then finally, we take a summation of all these cash flows to arrive at the net present value. Yeah. Let me see if we're getting similar answer. There is some difference. 105 profit is CFAT is 355. Institute solution has got 336 plus 150. 150 minus 100.8. 385. Tax on profits 600, 336. So we have subtracted it, 336. There is some problem, I think. So 336, on that you add the depreciation. So there's a difference of that 30. The institute solution, probably I think they have not considered the opportunity cost aspect. Yes, so there's an issue with the solution in the module. So we need to consider the opportunity cost of rent also. So we should be getting this. This is the correct answer. 404 is the NPV. Anyway, the conclusion is not going to get affected. The conclusion is basically, since your NPV is positive, we are definitely going to accept the project. Okay. What about the cost used to incur for disposal of waste earlier? I have considered that. Contract payments or the cost that is being saved, that is already considered. But Insured Solution hasn't considered this opportunity cost of rent. So there's a mistake in the solution, I think. Okay. So just refer this solution, guys. Because I think in the module, they haven't considered the opportunity cost aspect. Yeah. So there's this difference of 30 every time. 355 and 385, 437. That's the difference is only due to that 30 interest, I mean the rent which is lost. Okay, so we are through this typical question, which was question number 10. Any specific doubts if you have got, you can just bring it to me right now today. From all the previous chapters also, you can just raise your hand and I will allow you to speak so that we can interact and solve your career query right now over here. Any query, guys, from this from this topic or any of the previous topics which I have taught you, or any specific question you want me to solve for you, I can do that. Payment got reduced. Which payment, which is the opportunity cost of rent, that will be reduced, right? Because that is something which you would have got, but you're not going to get because of this project. So this new project is, preventing you from renting out this space, which you would have, fetched you a rent of 30 lakhs every year. Okay. Any other queries? Any other queries, guys? I'll just wait for some time, or else I'll take up another question if there are no queries from your end. You can just raise your hand. I'll allow you to speak. Why the idle wage payment got reduced? Okay. In first year, 225 was the expense which the question has stated as a wages expense, but there was an idle wage payment of 45 and 30. So this idle wage payment means you would have anyways paid this 45 lakhs in year one, even if the project was not accepted. So this idle wage payment, so you say that wages are 225, out of which 45 you would have paid even if the project was not accepted. So what is the extra wage payment that you're going to make because of this project? Because of this project, the extra or the additional wages that you're going to pay is, excluding this 45. So essentially, you're going to pay 180 as wages for the new workers, and the old workers who were idle, you were making them a payment of, this idle payment of 45. So the old workers which were which were looking for old workers which were looking for the 45 lakhs which you were making payment to the old workers, they will not be paid now in the first year. And similarly, the idle wage payments of 30, that won't be made payment in the second year, because they will be getting involved in this project, and I need not make anything extra payment. So any extra payment that we make, that is what we are going to consider over here. What is mutually exclusive project? Well, mutually exclusive project is those projects which you can either select, or you can suppose if there are two projects, you can select either one of them. So if you are selecting project A, you cannot select project B, and if you are selecting project B, you cannot select project A. Yeah, all clear, Sumit? Any other queries, guys? Clear? Ruhani is clear. Any specific question or any specific query that you have, we can get it sorted now. Okay. In real life, what happens, Sweetie Jasmine sir, does it have any impact on IRR due to high gaps between the two discounting rates? Yes. Yes, Sweetie, there will be a difference between the rates that you use for discounting. If you're keeping really very high gap, uh, there will be chances that you will have some sort of error. So ideally, I would recommend not to keep a gap of more than 5% between the two rates. Okay, not to keep a gap of more than 5%. So if you're keeping really large gap like 10 or 15%, then the IRR that you get may be significantly different than the real IRR. Okay. Aditya is saying in real life, what happens? Aditya, in what sense you're asking this? What happens in real life? In what essence? I mean, I'm not getting which aspect of the question or chapter you're asking for the real life. Yes, Aditya. What aspect of the question or the chapter you are talking of? An investment chapter. See, investment chapter, whatever we have done, that is very much related to the real life that we calculate. So when you go to corporates also, you'll find the similar techniques are being used for NPV IRR calculations also. Is it fine to have difference in answer after decimal point in IRR? Yes, it is absolutely fine. It's absolutely fine, sweetie. You can definitely have the difference. That difference is acceptable. Some smaller difference in the IRR, the decimal part is acceptable because it may differ. Like if you take a gap of 5%, someone else may take a gap of just 2%. So there may be difference in answer. That is acceptable. Yep. Any other query? Time permits. Can you do more long-based question? Long-based question time won't be fine right now. Let me see. Any other queries? Yes. How can we know the required rate of return in real life? Okay. In real life, the required rate of return is basically your cost of capital. The rate at which you have raised your funds, the rate of interest, the cost of equity. We have learned that in the cost of capital chapter. So whatever is that weighted average cost of capital, that itself is your required rate of return in the real life. Yeah. Any more queries, guys? Just wait for maybe another 5 minutes. Any queries, guys? You can just post it quickly, or you can raise your hand. I'll allow you to unmute and ask the queries that you have in this chapter or any previous chapters also. All the queries will be entertained. Exam practical will be more or theory. It will be a mix. You can refer the past papers to get an idea of what will be the trend of exams. So exam paper pattern can be a bit mix of theory as well as practical. Most of them you will find that there are practical problems along with case-based questions. You can refer to the past exam papers. I think I've solved one of the questions of past exam, that is in capital structure, or I think in leverage I have solved question, and ratio I have solved question of the past exam. So we do have practical to be of higher weightage. Any queries other than this? Question number 11 of capital structure. Okay. Just see. Question 11 of capital. Question number 11 or illustration number 11? Is it question number 11, or are you asking me the illustration number 11? Yeah. Question 11 or illustration? I think illustration number 11. That is pretty simple. It's just evaluation of all the three policies. So question number 11 you're talking about. Okay. The last question. Okay, so the last question is, the financial advisor of Sun Limited is confronted with the following two alternative financing plans of raising 10 lakhs that is needed for plant expansion. So it needs money for the purpose of plant expansion. The first option is to issue 80% of the funds with debentures and redeem at a premium of 10%, balanced by issuing equity shares as 33 1/3% premium. Second is raising 10% of funds by issuing 8% irredeemable debentures and remaining by issue of equity shares at a price of 125. Currently, they're saying firm is having earnings per share of 21. Modernization and expansion program is expected to increase the EBIT by 2 lakh. And the firm's condensed balance sheet is given. Finance advisor, you are concerned with the effect that issuing debt might have on the firm. The average debt ratio for the industry is 35%. And if this ratio is exceeded, P ratio will be 7. If the firm increases its equity capital by more than 10%, he expects the P ratio of the company will increase to 8.5. Okay, so specifically you want only the cost of equity part. So assume the target dividend payout ratio and alternative 60%, growth rate to be 10% for purpose of calculating cost of equity. So for cost of equity, under both the options, you have the EPS that will be generated. Okay, so you'll just write down the alternatives, you'll arrive at the profit after tax, you'll come at with EPS, and based on P, you will get the market price also. Now, for that EPS, 60% is the dividend payout. So you pay the 60% out of it. This dividend is going to grow at 10% every year. market price is also computed on the basis of the PE ratio. So you have dividend, you have market price, and then you can get the KE, which is D1 upon P0, right? So that's going to be simply your D1 upon P0. There's this growth aspect to it that is happening over here, 9.43 and 7.76%. So cost of equity is D1 upon P0 plus G, should it be there? 1 second. Is it going to be till perpetuity or how is it? Under assume dividend payout under each alternative is 60% for next year and growth rate to be 10%. Okay, so they are saying that growth rate has to be taken as 10% only for 1 year. Beyond that, they're saying it will be kept as a constant figure. So it's just D1 upon P0. There is no sustainable growth rate that we have in this question. And for that reason, we say this is going to be just 9.43%. Right? So next year dividend should be 60%. So D1 should be 60% of the EPS. So of course, this is your D0. This is your EPS 0. On that EPS 0, you are adding a growth of 10%. Or you can also say EPS growing by 10%, and out of that 60% will be the dividend. Okay. Fine. Is it clear? So earnings per share is 22.6. You have taken 60% of that. And on that, you have a growth of 10% for 1 year. Fine. So with that, let's just stop here for the day, guys. It was nice talking to you, all the students over here who have participated and who have joined in the lectures. So all the best for your upcoming exams and all the best for your CA finals. Thank you, everyone. Good night. Over.